Yes, it is set. You can start.
Yeah,
Sorry for
yeah,
the. I did not expect everyone to join so soon. So sorry for that.
yeah,
It's good actually. We'll make it a practice. Yeah.
yeah. So yesterday we read chapter 12 and 13, which were surprise and room for error. So yesterday we saw that how future is unpredictable. Things keep changing. Your goals keep changing. You yourself keep changing. So there is a very good chance that we'll be surprised with good or bad things, and that is inevitable. They make an impact on our plans, so we have to also understand the impact and try to handle them. That is as far as surprise is concerned. That we have to link with room for error. So to accommodate these surprises or to make some margin of safety for these surprises, we'll have to understand the room for error, and then we will have to make use of this concept and try to build a buffer for our investments, career, and life, any life decisions. While taking those decisions, we need to consider these two factors. So, moving on to the next chapter, you will change. So, let's see what it is about. Long term planning is harder than it seems because people's goals and desires change over time. I grew up with a friend who came from neither privilege nor natural intellect, but was the hardest working guy I knew. These people have a lot to teach because they have an unfiltered understanding of every inch of the road to success. His life's mission and dream as a teenager was to be a doctor. To say the odds were stacked against him in is being charitable. No reasonable person at the time would consider it a possibility. But he pushed, and a decade older than his classmates, he eventually became a doctor. How much fulfillment comes from starting from nothing, bulldozing your way to the top of medical school, and achieving one of the most noble professions against all odds? I spoke to him a few years ago. The conversation went like this: Me, long time no talk. How you doing? Him, awful career. Me, haha, well. Him, awful career, man. This went on for 10 minutes. The stress and hours had worn him into the ground. He seemed as disappointed in where he is today as he was driven today toward where he wanted to be 15 years ago. An underpinning of psychology is that people are poor forecasters of their future selves. Imagining a goal is easy and fun. Imagining a goal in the context of the realistic life stresses that grow with competitive pursuits is something entirely different. This has a big impact on our ability to plan for future financial goals. Every 5-year-old boy wants to drive a tractor when they grow up. Few jobs look better in the eyes of a young boy whose idea of a good job begins and ends with vroom vroom, beep beep, big tractor, here I come. Then many grow up and realize that driving a tractor maybe isn't the best career. Maybe they want something more prestigious or lucrative. So, as a teenager, they dream of being a lawyer. Now they think they know their plan is set. Law school and its costs? Here we come. Then, as a lawyer, they face such long working hours that they rarely see their families. So, perhaps they take a lower paying job with flexible hours. Then they realize that childcare is so expensive that it consumes most of their paycheck and they opt to be a stay at home parent. This, they conclude, is finally the right choice. Then at age 70, they realize that a lifetime of staying home means they are unprepared to afford retirement. Many of us wind through life on similar trajectory. Only 25% of college grads have a job related to their major according to the Federal Reserve. 29% of stay-at-home parents have a college degree. Few likely regret their education, of course. But we should acknowledge that a new parent in their 30s may think about life goals in a way their 18-year-old self making career goals would never imagine. Long-term financial planning is essential, but things change both the world around you and your own goals and desires. It is one thing to say we don't know what the future holds. It's another to admit that you yourself don't know today what you will want in the future. And the truth is, few of us do. It's hard to make enduring long term decisions when your view of what you will want in the future is likely to shift. The end of history illusion is what psychologists call the tendency for people to be keenly aware of how much they have changed in the past, but to underestimate how much their personalities, desires, and goals are likely to change in the future. Harvard psychologist Daniel Gilbert once said, "At every stage of our lives, we make decisions that will profoundly influence the lives of the people we are going to become. And then, when we become those people, we are not always thrilled with the decisions we have made." So, young people pay good money to get tattoos removed that teenagers paid good money to get. Middle aged people rush to divorce people who young adults rush to marry. Older adults work hard to lose what middle aged adults worked hard to gain. On and on and on. All of us, he said, are walking around with an illusion that history, our personal history, has just come to an end, that we have just recently become the people that we were always meant to be and will be for the rest of our lives. We tend to never learn this lesson. Gilbert's research shows people from age 18 to 68 underestimate how much they will change in the future. You can see how this can impact a long-term financial plan. Charlie Munger says the first rule of compounding is to never interrupt it unnecessarily. But how do you not interrupt a money plan, careers, investments, spending, budgeting, whatever, when what you want out of life changes? It's hard. Part of the reason people like Ronald Reid, the wealthy janitor we met earlier in the book, and Warren Buffett became so successful is because they kept doing the same things for decades on end, letting compounding run wild. But many of us evolve so much over a lifetime that we don't want to keep doing the same thing for decades on end or anything close to it. So rather than one 80-something years lifespan, our money has perhaps 4 distinct 20-year blocks. I know young people who purposefully live austere lives with little income and they are perfectly happy with it. Then there are those who work their tails off to pay for a life of luxury and they are perfectly happy with that. Both have risks, the former risks being unprepared to raise a family or fund retirement. The latter risks regret that you spent your youthful and healthy years in a cubicle. There is no easy solution to this problem. Tell a 5-year-old boy he should be a lawyer instead of a tractor driver, and he will disagree with every cell in his body. But there are two things to keep in mind when making what you think are long term decisions. We should avoid the extreme ends of financial planning, assuming you will be happy with a very low income or choosing to work endless hours in pursuit of a high one increases the odds that you will one day find yourself at the point of regret. The fuel of the end of history illusion is that people adapt to most circumstances, so the benefits of an extreme plan, the simplicity of having hardly anything, or the thrill of having almost everything wears off. But the downsides of those extremes, not being able to afford retirement or looking back at life spent devoted to chasing dollars, become enduring regrets. Regrets are especially painful when you abandon a previous plan and feel like you have to run in the other direction twice as fast to make up for lost time. Compounding works best when you can give a plan years or decades to grow. This is true for not only savings but careers and relationships. Endurance is key. And when you consider our tendency to change, who we are over time, balance at every point in your life becomes a strategy to avoid future regret and encourage endurance. Aiming at every point in your working life to have moderate annual savings, moderate free time, no more than a moderate commute, and at least moderate time with your family increases the odds of being able to stick with a plan and avoid regret than if any one of those things fall to the extreme sides of the spectrum. We should also come to accept the reality of changing our minds. Some of the most miserable workers I have met are people who stay loyal to a career only because it's the field they picked when deciding on a college major at age 18. When you accept the end of history illusion, you realize that the odds of picking a job when you are not old enough to drink that you will still enjoy when you are old enough to qualify for social security are low. The trick is to accept the reality of change and move on as soon as possible. Jason Zwick, the Wall Street Journal investment columnist, worked with psychologist Daniel Kahneman on writing Kahneman's new book, Thinking Fast and Slow. Zweig once told a story about a personality quirk of Kahneman that served him well. Nothing amazed me more about Danny than his ability to detonate what we had just done. Zweig wrote, he and Kahneman could work endlessly on a chapter, but the next thing you know, Kahneman sends a version so utterly transformed that it is unrecognizable. It begins differently, it ends differently, it incorporates anecdotes and evidence you never would have thought of. It draws on research that you have never heard of. When I asked Danny how he could start again as if we had never written an earlier draft, Zwick continued. He said the words I have never forgotten. I have no sunk cost. Sunk costs. Anchoring decisions to past efforts that can't be refunded are a devil in the world where people change over time. They make our future selves prisoners to our past, different selves. It's the equivalent of a stranger making major life decisions for you. Embracing the idea that financial goals made when you were a different person should be abandoned without mercy versus put on life support and dragged on can be a good strategy to minimize future regret. The quicker it's done, the sooner you can get back to compounding. Next, let's talk about compounding's price of admission. Anybody would like to read chapter 15, Nothing's Free?
I love the chapter. In fact, can't agree to every word of it.
Yeah.
Yeah. I can read uh, if no one is there to read. Like anyone else wants to read, then I can take after them. Okay, sure. I'll read. Nothing's free. Everything has a price, but not all prices appear on labels. True. Everything has a price, and the key to a lot of things with money is just figuring out what that price is and being willing to pay it. The problem is that the price of a lot of things is not obvious until you have experienced them firsthand when the bill is overdue. General Electric was the largest company in the world in 2004, worth a third of $1 trillion. It had either been first or second each year for the previous decade. Capitalism's shining example of corporate aristocracy. Then everything fell to pieces. The 2008 financial crisis sent GE's financing division, which supplied more than half the company's profits, into chaos. It was eventually sold for scrap. Subsequent bets in oil and energy were disasters, resulting in billions in write offs. GE stock fell from $40 in 2007 to $7 by 2018. Blame placed on CEO Jeff Immelt, who ran the company since 2001, was immediate and harsh. He was criticized for his leadership, his acquisitions, cutting the dividend, laying off workers, and of course, the plunging stock price. Rightly so, those rewarded with dynastic wealth when times are good hold the burden of responsibility when the tide goes out. He stepped down in 2017. But Immel said something insightful on his way out. Responding to critics who said his actions were wrong and what he should have done was obvious, Immel told his successor, every job looks easy when you're not the one doing it. So true. Every job looks easy when you're not the one doing it because the challenges faced by someone in the arena are often invisible to those in the crowd. Dealing with the conflicting demands of sprawling bloat, short term investors, regulators, unions, and entrenched bureaucracy is not only hard to do, but it's hard to even recognize the severity of the problems until you are the one dealing with them. Imel's successor, who lasted 14 months, learned this as well. Most things are harder in practice than they are in theory. Sometimes this is because we are overconfident. More often it's because we are not good at identifying what the price of success is, which prevents us from being able to pay it. The S&P's 500 increased 119-fold in the 50 years ending 2018. All you had to do was sit back and let your money compound. But of course, successful investing looks easy when you're not the one doing it. Hold stocks for the long run, you'll hear it's good advice. But do you know how hard it is to maintain a long term outlook when stocks are collapsing? Like everything else worthwhile, successful investing demands a price. But its currency is not dollars and cents, it's volatility, fear, doubt, uncertainty, and regret, all of which are easy to overlook until you're dealing with them in real time. The inability to recognize that investing has a price can tempt us to try to get something for nothing, which, like shoplifting, rarely ends well. Say you want a new car, it's cost $30,000. You have three options. One, pay $30,000 for it. Two, find a cheaper used one. Or three, steal it. In this case, 99% of people know to avoid the third option, but the consequences of stealing a car outweigh the upside. But say you want to earn an 11% annual return over the next 30 years so you can retire in peace. Does this reward come free? Of course not. The world is never that nice. That's a price tag, a bill that must be paid. In this case, it's a never ending taunt from the market, which gives big returns and takes them away just as fast, including dividends. The Dow Jones Industrial Average return about 11% per year from 1950 to 2019, which is great. But the price of success during this period was dreadfully high. The shades lines in the chart show when it was at least 5% below its previous all time high. Okay, here's the graph. More than 5% below previous all time high, Dow lowest industrial average. Okay. This is the price of market returns, the fee. It is the cost of admission and it hurts. Like most products, the bigger the return, the higher the price. Netflix stock returned more than 35,000% from 2002 to 2018, but traded below its previous all time high on 94% of days. Monster Beverage returned 3,19,000% from 1995 to 2018, among the highest returns in history, but traded below its previous high 95% of the time during that period. Now, here's the important part. Like the car, you have a few options. You can pay this price, accepting volatility and upheaval, Or you can find an asset with less uncertainty and a lower payoff, the equivalent of a used car. Or you can attempt the equivalent of Grand Theft Auto. Try to get the return while avoiding the volatility that comes along with it. Many people in investing choose the third option, like a car thief. Though well meaning and law abiding, they form tricks and strategies to get the return without paying the price. They trade in and out. They attempt to sell before the next recession and buy before the next boom. Most investors with even a little experience know that volatility is real and common. Many then take what seems like the next logical step, trying to avoid it. But the money gods do not look highly upon those who seek a reward without paying the price. Some car thieves will get away with it, many more will be caught and punished. Same thing will in investing. Morningstar once looked at the performance of tactical mutual funds whose strategy is to switch between stocks and bonds at opportune times, capturing market returns with lower downside risk. They want the returns without paying the price. The study focused on the mid 2010 through late 2011 period when US stock markets went wild on fear of a new recession and the S&P 500 declined more than 220%. This is the exact kind of environment the tactical funds are supposed to work in. It was their moment to shine. There were, by Morningstar's count, 112 tactical mutual funds during this period. Only 9 had better risk adjusted returns than a simple 60-40 stock bond fund. Less than a quarter of the tactical fund had smaller maximum drawdowns than the level it alone index. Morningstar wrote, with a few exceptions, tactical fund gained less, were more volatile, or were subject to just as much downside risk as the hands off fund. Anyone wants to read from here? Anyone interested? Okay. No one wants to read today?
Yeah, I can
I'll
read.
go.
Okay, okay. Go on, go on.
Individual investors fall for this when making their own investments too. The average equity fund investor underperformed the funds they invested in by 0.5% per year, according to Morningstar. The result of buying and selling when they should have just bought and held. The irony is that by trying to avoid the price, investors end up paying double. So back to GE, one of its many faults stems from an era under former CEO Jack Welch. Welch became famous for ensuring quarterly earnings per share beat Wall Street estimates. He was the grandmaster. If Wall Street analysts expected $0.25 per share, Jack would deliver $0.26 no matter the state of business or the economy. He would do that by massaging the numbers. That description is charitable, often pulling gains from future quarters into the current quarter to make the obedient numbers salute their master. Forbes reported one of dozens of examples. General Electric, for 2 years in a row, sold locomotives to unnamed financial partners instead of end users in transactions that left most of the risk of ownership with GE, that is General Electric. Welch never denied this game. He wrote in his book, Straight from the Gut. Straight from the Gut. He wrote in his book, Straight from the Gut. The response of our business leaders to the crisis was typical of the GE culture. Even though the books had closed on the quarter, many immediately offered to pitch in to cover the gap, that earnings gap. Some said they would find an extra $10 billion, $20 billion, and even $30 million from their business to offset the surprise. The result was that under Welsh leadership, stockholders didn't have to pay the price. They got consistency and predictability, a stock that surged year after year without the surprises of uncertainty. Then the bill came due, like it always does. GE shareholders have suffered through a decade of mammoth losses that were previously shielded by accounting maneuvers. The penny gains of Wells' era became dime losses today. The strangest example of this comes from failed mortgage giants Freddie Mac and Fannie Mae, which in the early 2000s were caught underreporting current earnings by billions of dollars with the intention of spreading those gains out over future periods to give investors the illusion of smoothness and predictability. So, the illusion of not having to pay the price. The question is, why do so many people who are willing to pay the price of cars, houses, food, and vacations try so hard to avoid paying the price of good investment returns? The answer is simple. The price of investing success is not immediately obvious. It is not a price tag you can see. So, when the bill comes due to it, doesn't feel like a fee for getting something good. It feels like a fine for doing something wrong. And while people are generally fine with paying fees, fines are supposed to be avoided. You are supposed to make decisions that preempt and avoid fines. Traffic fines and IRS fines means you did something wrong and deserve to be punished. The natural response for anyone who watches their wealth decline and views the drop as a fine is to avoid future fines. It sounds trivial, but thinking of market volatility as a fee rather than a fine is an important part of developing the kind of mindset that lets you stick around long enough for investing gains to work in your favor. Few investors have the disposition to say, I'm actually fine if I lose 20% of my money. This is doubly true for new investors who have never experienced a 20% decline. But if you view volatility as a fee, things look different. Disneyland tickets cost $100, but you get an awesome day with your kids you will never forget. Last year, more than 18 million people thought that fee was worth paying. Few felt that $100 was a punishment or a fine. The worthwhile trade-off of fees is obvious when it is clear you are paying one. Same with investing, where volatility is almost always a fee, not a fine. Market returns are never free and never will be. They demand you pay a price like any other product. You're not forced to pay this fee, just like you're not forced to go to Disneyland. You can go to the local country fair where tickets might be just $10 or stay home for free. You might still have a good time, but you'll usually get what you pay for. Same with markets. The volatility, that is uncertainty fee, the price of returns is the cost of admission to get returns greater than low fee parks like cash and bonds. The trick is convincing yourself that the market fee is worth it. Market's fee is worth it. That is the only way to properly deal with volatility and uncertainty, not just putting up with it, but realizing that it is an admission fee worth paying. There is no guarantee that it will be. Sometimes it rains at Disneyland. But if you view the admission fee as a fine, you will never enjoy the magic. Find the price, then pay it. Yeah. Should anyone take this? Hello? Anyone willing to do with this chapter? Yeah.
Yeah, I'll take it from here. Chapter 6, You and Me. Beware taking financial cues from people playing a different game than you are. I'll repeat. Oh, that's okay. You can move on. Beware taking financial cues from people playing a different game than you are. The implosion of the dot-com bubble in the year 2000s reduced household wealth by 6.2 trillion. The end of the housing bubble cut away more than 8 trillion. It's hard to overstate how socially devastating financial bubbles can be. They ruin lives. Why do these simple things happen? And why do they keep happening? Why can't we learn our lessons? The common answer here is that people are greedy, and greed is an inedible feature of human nature. That may be true, and it's a good enough answer for most. But remember from chapter 1, no one is crazy. People make financial decisions they regret, and they often do so with uh, scarce information and without logic. But the decisions made sense to them when they were made. Blaming bubbles on greed and stopping their misses most important lessons about how and why people rationalize what's in the why people rationalize what's in the hindsight looks like greedy decisions. Part of why bubbles are hard to learn from this, part of why bubbles are hard to learn from is that they are not like cancer, where a biopsy gives us a clear warning and diagnosis. They are closer to the rise and fall of political party, where the outcome is known in the hindsight, but the cause and blame are never agreed upon. Competition for investment returns is fierce, and someone has to own every asset at every given point in time. That means the mere idea of bubbles will always be controversial because no one wants to think they own a overvalued asset. In hindsight, we are more likely to point cynical fingers than to learn lessons. I don't think we'll ever be able to fully explain why bubbles occur. It's like asking why wars occur. There are almost always several reasons, many of them conflicting, all of them controversial. It's too complicated a subject for simple answers. But let me propose one reason they happen that both goes overlooked and applies to you personally. Investors often innocently take cues from other investors who are playing a different game than they are. An idea exists in finance that seems innocent but has done incalculable damage. It's a notion that assets have one rational price in a world where investors have a different goals and time horizons. Ask yourself, how much should you pay for Google stock today? The answer depends on who you are. Do you have a 30-year-old do you have a 30-year time horizon? Then the smart price to pay involves a sober analysis of Google's discounted cash flows over next 30 years. Are you looking to cash out within 10 years? Then the price to pay can be figured out by an analysis of the tech industry's potential over the next decade and whether Google management can execute on its vision. Are you looking to sell within a year? Then pay attention to the Google's current product sales cycles, whether we'll have a bear market. Are you a day trader? Then the smart price to pay is who cares? Because you're just trying to squeeze a few bucks out of whatever happens between now and a lunchtime, which can be accomplished at any price. When investors have different goals and time horizons, and they do in every asset class, prices that look ridiculous to one person can make sense to another because the factors those investors are pay attention to are different. Take the dot-com bubble in 1990s. People can People can look at Yahoo stock at 1999 and say that was crazy, a zillion times revenue. A valuation made no sense. But many investors who owned Yahoo stock at 1999 had time horizon so short that it made sense for them and pay a ridiculous price. A day trader could accomplish what they need whether Yahoo was at a $5 a share or $500 a share as long as it moved in the right direction that day. And it did for years. The iron rule of finance is that money chases returns to the greatest extent that it can. If an asset has momentum, it's been moving consistently up for the period of time. It's not crazy for a group of short-term traders to assume that it will keep moving up. Not indefinitely, just for the short period of time they need it to. Momentum attracts short-term traders in a reasonable way. Then it's off to the races. Bubbles form when the momentum of short-term returns attracts enough money that the makeup of investors shifts from mostly long-term to short-term. That process feeds on itself. As traders push up short-term returns, they attract even more traders. Before long, and it often doesn't take long, that dominant market price setters with the most authority are those with shorter time horizons. Bubbles aren't so much about valuation rising. That's just a symptom of something else. Time horizon shrinking as more short-term traders enter the playing field. It's common to say dot-com bubbles was the time of irrational optimism about the future. But one of the most common headlines of that era was announcing record trading volume, which is what happens when investors are buying and selling in a single day. Investors, particularly the ones setting prices, were not thinking about the next 20 years. The average mutual fund had 120% annual turnover in 1999, meaning they were at most thinking about the next 8 months. So, where the individual investor who bought those mutual funds, Maggie Mahar, uh, Maggie Mahar wrote in her book Bull. By the mid 90s, the press had replaced annual scorecards with reports that appeared every month. The change spurred investors to chase performance, rushing to buy the funds at the top of the charts, just when they were most expensive. This was the era of day trading, short-term options contracts. This was the era of day trading, short-term option contracts, and up to the minute market commentary. It's not the kind of thing you'd associate with long-term views. The same thing happened during the housing bubble of mid-2000s. It's hard to justify 700,000. It's hard to justify paying $700,000 for two-bedroom Florida tract home to raise your family for the next 10 years. But it makes perfect sense if you plan on flipping the home in a few months into a market with raising prices to make a quick profit, which is exactly what many people were doing during that time, during the bubble. Data from Antom, a company that tracks real estate transactions, shows the number of houses in America that sold more than once in 12-month period. They were flipped. Rose five-fold during the bubble, from 20,000 in the first quarter to 2,000 to over 100,000 in the first quarter of 2004. Flipping plunged over the bubble is less than 40,000 per quarter. where it's roughly remained since. Do you think these flippers cared about long-term price to rent rations, or whether the prices they paid were backed up by the long-term income growth? Of course not. Those numbers weren't relevant on their game. The only thing that mattered to the flippers was that the price of the home would be more next month than that wasn't this month. And many years it was. You can say a lot about these investors. You can call them speculators, you can call them irresponsible, you can shake their head at their willingness to take huge risk. But I don't think you can call them irrational. Yeah, you can call all of them irrational. The formation of bubbles isn't so much about people irrationally participating in a long term investing. They are about people somewhat rationally moving towards the short term trading to capture momentum that had been feeding on itself. What do you expect people to do when momentum creates a big? What do you expect what do you expect people to do when momentum creates a big short term return potential? Sit and watch patiently? Never. That's not how the world works. Profits will always be chased, and short term traders operate in an area where the rules governing long term investing, particularly along the valuation, are ignored because they are irrelevant on the games being played. That's where the things gets interesting and where the problems begin. Bubbles do their damage when long-term investors playing one game start taking their cues from those short-term traders playing another. Can anybody take from this? Or shall I continue?
Yeah, if you can continue, it is still page 148 that you'll have to read to complete the
Okay. Sure, I'll go. Cisco stocks rose 300% in 1999 at 2. Cisco stocks rose 300% in 1999 to $60 per share. At that price, the company was valued $600 billion, which is insane. Few actually thought it was worth that much. The day traders were just having their fun. Economist Burton Malkiel once pointed out the Cisco's implied growth rate at that valuation means it would become the larger than the entire US economy within 20 years. But if you are a long-term investor in 1999, $60 was the only price available to buy. Many people were buying it at that price. So you may have looked around yourself. You may have looked around and said it to yourself, wow, maybe these other investors, something I don't. Wow, maybe these other investors know something that I don't. Maybe you went along with it. You even felt smart about it. What you don't realize is that traders who are setting that marginal price of the stocks were playing a different game than they were playing a marginal price of stocks were playing a different game than you were. $60 a share was reasonable price for the traders because they planned on selling the stocks before the end of the day, when its price would probably be higher. But $60 was a disaster in making for you because you planned on holding shares for long run. These two investors rarely even know that each other exists, but they're on the same field, running towards each other. When their paths blindly collide, someone gets hurt. Many finance and investment decisions are rooted in watching what other people do and either copying them or betting against them. But when you don't know why someone behaves like but when you don't know why someone behaves like they do, you won't know how long they'll continue acting that way, what will make them change their mind, or whether they'll ever learn their lesson. When a commentator on CNBC says you should buy this stock, Keep in mind that they do not know who you are. Are you a teenager trading this for fun? An elderly widow on limited budget? A hedge fund manager trying to shore up your books before the quarter ends? Are we supposed to think those three people have a same priorities and that whatever a level of particular stocks is trading at is the right for all of them? It's crazy. It's hard to grasp that the other investments have different goals than we do, because an anchor of psychology is not realizing that rational people can see the world through a different lens than your own. Rising prices persuade all investors in a ways that the best markets envy. They are drug that they are a drug that can turn value conscious investors into dewy-eyed optimists, detached from their own reality by actions of someone playing a different game than they are. Being swayed by people playing a different game can also throw off how you think you're supposed to spend your money. So much consumer spending, particularly in developed countries, is socially driven, subtly influenced by people you admire, and done because you subtly want other people to admire you. But while we can see how much money other people spend on cars, homes, clothes, and vacations, we don't get to see their goals, worries, and aspirations. A young lawyer aiming to be partner at a prestigious law firm might need a maintain a appearance that a writer who can work in the sweatpants. I'll repeat the phrase again. But while we can see how much money other people spend on cars, homes, clothes, and vacations, we don't get to see their goals, worries, and aspirations. A young lawyer aiming to be partner at the prestigious law firm might need a maintain an appearance that a writer who can work in the sweatpants, have no need for. But when his purchases set own expectations, I'm wandering down a path of potential disappointment because I'm spending the money without the career boost he's getting. We might not have we might not even have different styles. We are just playing a different game. It took me years to figure this out. The takeaway here is that few things matter more with money than understanding your own time horizon and not being persuaded by the actions and behaviors of people playing different games than you are. The main thing I can recommend is going out your way to identify what game you are playing. It's surprising how few of us do. We call everyone investing money investors, like they're basketball players, all playing same game with the same rules. When you realize how wrong that notion is, you seeing you when you realize how wrong that notion is, you see how vital it is to identify what game you are playing. How I invest my own money is detailed in chapter 20, but years ago I wrote out, I am a passive investor optimistic in the world's ability to generate real economic growth. And I'm confident that over next 30 years, that growth will occur to my investment. This might seem quaint, but once you write that mission statement down, you realize everything that's unrelated to it, what the market did this year, or whether we'll have a recession next year, is a part of game I'm not playing. So I don't pay attention to it, and I am in no danger of being persuaded by it. Next, let's talk about pessimism.
Yeah, thanks, Pravina. We'll stop here for the day. Yeah, so let's reflect back on whatever we read today. What were the aha moments? What were the points stood out? And what were just, you seem to be nodding your head that, yeah, I know this, I agree to this, and that's fine.
Can I go?
Yeah, please.
Yeah, to be honest, on this session, it is more of the words that I think it is more of the technology that we use on the stocks. But I think this book is so much so that it reflects so much on the real psychology of how we are living life. So I would say the key takeaway for me is that when he told about the plans that we don't have for the next few years, like when it comes to life, a 30-year-old views is different from a 40-year-old view. I think that is quite relatable for me. Though it was all about the stocks and investing money, but I think it is a key takeaway for everyone to actually assume and look out for the future in a different perspective and open to be changed for the other coming years. So that is one takeaway. The next is that when it comes to uh, understanding the stock, I mean, like the market of how it's going to be, I can see that most of it is like uh, a future predicted thing. So again, I could able to totally relate on the other level of understanding of psychology of life, I would say. Yeah, that is my takeaway here.
Great. Thanks for your summary. Yeah. What about others? What stood
No,
out?
I didn't get the last thing, the psychology of life. If you can answer that.
Um,
Actually, Praveena was saying that she could relate to whatever was, whatever this book says to better understand the way life works. I think that is what she meant by her ending line.
Yeah.
No, but what is the specific point at the end? I'm asking.
So yeah, as I mentioned, it is about like I mean, going to the details part, I really couldn't able to understand what the bubbles mean here, because again, I think that is more of the money perspective. But what I've understood is that it is the way that they have explained about the future, about how we are going to see about the money, and when it comes to the money being different at different time zones, that is what I could able to relate with the life of how we are viewing it. So that the psychology of how we are viewing the life is what I meant.
If I may say, so what Praveena means is, when we are talking about investments, we should be concerned about our own investment growth and our returns that we want, and not be concerned about how a day trader is earning or what the investment criteria for others is. The same as when we in life we say that your own definition of success is what should or purpose is what should be your way of working towards. What others are doing should not be a question that you should be concerned. So, if I'm correct, that is what we mentioned.
Yes.
That even though they're talking about money, investing. So, when he's talking about investing, he's saying that you should know, you should have a clear idea of what you want from your investment, what returns you are looking for. Are you a long-term investor? Are you a short-term investor? Do you want to trade into equities or debt or whatever? So that's psychology. And that psychology gives good for a person living his or her life, not being, uh, taken by the glitter and glam of other people's life, other people's success, but to stand course, on your own path.
Yeah. Thank you, Sunita. That explains it better. Thank you.
Yeah, so I think it talks about not going into a comparison mode or not going into taking decisions on the basis of someone else who has maybe different age group, different purpose, different goals, different needs. And thereby, whatever is the assumption there the person investing is having, maybe those assumptions are not applicable to you and me. So we'll have to understand, we'll have to gain that clarity and take decisions.
Maybe being accountable for the decision that you take. Maybe
Yeah, accountable is ultimately we'll have to be accountable, yes. But that's what, we have to take a conscious call rather than just go basis the crowd, wherever the crowd goes, if you're just following. then that might not be wise for you because your requirement might be different. And as I said, the assumption which the investor is having when he does an investment versus what you are assuming, the example that they gave, that you have to purchase a flat versus you rent a flat, right, will be much different for a person who actually needs a house versus a person who has extra cash to invest, right?
Mm.
So there will be different circumstances and you will have to make a decision, but ultimately you will have to bear the fruit of the decision. So make it more with a clarity and a deeper understanding rather at a surface level, just following certain people who you think are, leading the thing, leading your decision or facing similar situations.
So the
Yeah.
goals may be different. Okay.
Yeah. So goals, purpose, age group, needs. What is my need right now? Maybe is I need a house just to stay. For maybe rent is fine because I also may be just requiring it at a urgent. So if I don't have much money, I might not want to buy a house just for a temporary. So it will depend on my need also, right? Yeah. Any other points that stood out?
For me also, these were the highlights of today's reading and my takeaways, where the author focused on like the changes that happen and how they affect our goals. Like your goals at 18 will be different than your goals at 30, investment goals and your reasons behind them. And I love that part where he in that chapter where he mentions that eventually like as you grow older, balance become our strategy. So I like that line and that part where actually we are all seeking balance. Like at certain point, as we grow older and older, we get closer to having these as our priorities. And also the chapter nothing is free, like in that also where he explains that everything has a cost. Sometimes the cost is not seen directly, but it has a cost, and the way he has explained those cost, like the cost could be your uncertainty, the cost could be all those other things like the negativities or the things that really hamper us, those could be the cost of higher returns. So that was a very different perspective for me. And again, as you all discussed already, maybe that everyone is playing a different game. So if we understand this, we get out of that comparison parameter of someone else's. And also what I felt like, I liked that line where he mentioned that the stock in like the CNBC guy or the guy on TV, he's mentioning these stocks to buy, but actually he don't know who you are and what are your priorities. So normally this is how we go, right? Like this purchase, this is at a high, this is at a low, and all of that. But actually we never consider it from a perspective of is it relevant enough for me. So I love this points, and I feel the lessons or the things that are mentioned in this chapter, although they are money specific, and the author has mentioned it from the money perspective. I think many of the statements and many of the things are very uh, useful and relevant even in the other areas of our life, not just when it comes to money, but like as such, it's very crucial, and it's even relevant over other places, like not to compare, everyone is playing their own game and things like that, many things in fact. So yeah, that was my personal takeaway for today.
I just wanted to add one more thing that made mark for me was the fact that you have to look at it as a fee, the the fluctuation that is there, when you're holding something, rather than taking it as a fine, the volatility as a fine. You look at it as a fee that you need to pay. And the parable that he drew to the Disney tickets, so that was very good, and that made a lot of sense for me.
Yes, and even that extreme part, right? Like don't like whatever the case, he also mentioned that
Exactly. Yeah,
at
yeah.
70, don't think of the extremes, like whatever it is, a person who might make some choices of having flexible income and all of that might feel broke at the age of retirement, and vice versa, at the doctor's story, right? His friend's story where he felt like it's awful. So any extremes that we assume, we never know. Like that part also was nice. Yeah. I feel throughout the book the author is somewhere like seeding this thought of moderation and simplicity in our life somewhere. Like throughout the beginning, I feel that's been the tone of the book, where he explains, he talks about extremes, both the extremes. He gives examples, and then he eventually makes us think that how you should not be part of any of the extremes, and you should seek your own balance, kind of a thing. It's like my perspective of this so far.
Yeah. Thanks, everyone. Manishi, you have anything to say or add?
Yeah, I just want to share a few things. See, the thing is all about psychology of money and investing and things like that. Because I do so many things about different areas like real estate and other investment decisions. That when we start our investing journey, we should make whether return might be low, but we should focus on safe returns, right? So because sometimes what happen is slow progress is good, and it grows with the power of compounding. Over a period of time it will give very huge returns. But if we do the other way in the beginning, like for the market volatility or anything which are high return but high risky also, and sometimes people get money and make poor decisions, and don't get the benefit of compounding over a period of time. So it's all about and when you have accumulated returns over a period of time, let's say you have 100 rupees, right? So you can start making uh, on some little more risky investments, so that if you lose also, you don't lose your investment money, right? So that's how I should invest 75% of money in properties like real estate, because I feel the best investment on earth in terms of safety is earth. Maybe the returns are less than the stock market, but the returns are safer because the land is limited, right? So I make my 75% in purchasing land and the real estate investment, and I invest like say 10 to 15% in stock market, 10% in gold, like 5% in insurance or other FDs and things like that. So I basically diversify myself so that at least my principal is safe and maybe less returns. So when I accumulate that over a period of time, then if I want 100 rupees, then I can risk my 10 rupees, right? So if I lose my 10 also, then I still have 90 to survive my business. So that's how the power of compounding works. They have to compromise, because this is your the hardcore investment money that you cannot compromise, right? But when you start making power of compounding, then maybe you can diversify more, maybe may do little more extra risky investments which might return high returns, right? So my focus is that we should focus on safety very much than the high returns. Because anyway, uh, in the earlier chapters also, Warren Buffett said he like 90% of his money came only after 65 years of age, right? So the power of compounding will give you good returns over a period of time, good enough for life. This is what the author stated. So my focus is like being mindful of your risky areas and non-risky areas, and basically use the power of compounding, because that's a very powerful tool. This is what I want to share. Yeah, thank you.
Thanks, Manish, for stressing on the requirement to have a diversified kind of a investment and also understand the compounding part of money. Yes, patience is required because compounding takes time. Yeah. So, yeah. So today's, I think, session was a bit more deeper because the first chapter was about you will change. So generally, when I take decisions or when I look into future, I never accommodate or rather factor this kind of an understanding that I will change, my requirements will change, or my goalposts would have changed, my age would have changed, my requirements will change. So yes, this is more of a awareness that permanence is an illusion. And thereby, when I do a long-term planning, I must also understand my future shifts in my identity, in my requirement, be mindful of that so that the plan that I have will become flexible and not rigid to what my current situation is. But practically also I see, maybe I will not be able to overestimate these things or estimate to the perfection. So will I have to accept that there will be certain assumptions that I need to make in terms of future, considering these things. Generally, when I try to make any change, sunk cost is something which pushes me down. It might be any investment I've already made, any time, any effort investment. So one has to look at sunk cost in a different manner if the flexibility or the change has to happen. That is what this book also suggests, that how do you look at sunk cost, and many people look at what they have already put in money, put efforts into, spend time into careers as a binding thing for them to make any change in the now or in the future. So that is something which we have to understand, whether the past is so binding on us that it doesn't allow us to change our course in the future. Coming to nothing's free. This brings to me, to the understanding that gratitude as an emotion, it's more of a feeling, a conscious feeling, I would say. Why it is not natural? Because you have to give a thought, you have to understand that you have to be gracious or gratitude about something. This is because I think our mind only works when we have a label or a price on the product or anything. Our mind understands or values that as a measuring rod. But when I say a family, love, a comfortable support system, all those don't have values. So generally we overlook and we do not understand the importance of that. So this chapter also makes you think that nothing comes free. If you want to get something, you have to pay the price. When it comes to the price, as I just said, that you might understand the price tags which are obvious, that you have to make so much of investment of time, money into something. But the other aspects which don't have a price tag might be ignored. So one has to actually deeply think and understand what are the other costs one is paying in terms of doing something or achieving some success or pursuing a goal, basically. So that understanding has to come, and if the person is ready to pay the price and bear, then ideally he should go ahead. Otherwise, be satisfied, because there are a lot of opportunity costs. If you don't do a certain path of things, you will not reach the goal, but then you can do something else. So yes, life is a bit complicated, a bit complex, but yes, you will have to cut off your, cancel out the options which are not working for you. The reason why we have to do that is to avoid the regret. To some extent, regret will always be there, because we can't always anticipate or not always satisfy ourselves. But yes, if we are a bit more careful and have a much more understanding of ourselves, our requirement, before we actually start paying the price, it is better that we don't have to pay a larger price of regret. Then coming to the example where the fee versus fine. If we agree to pay the price, then let us look it as a fee rather than having a think it as a fine, because any which ways we have agreed to pay it. And when I pay a fee, then I should try to maximize the gain out of it. So that deeper understanding one has to come that it's a fee, not a fine. Coming to chapter 16, you and me. So the word you and me itself shows that you are different, me, I am different. So my requirement, my needs, my goals, my aspiration, my definition of success is not is what is yours. Now, when we say two of us make the same financial decision, my assumptions for the decisions might be different versus your assumptions. My requirements might be different. So at the end, the decisions that we take are from a different set of perspectives. Ideally should be from a two different set of perspectives. But generally what happens is, since my friend bought this car, I buy the car. So the author is trying to showcase how normally we do. Second thing is, we do this like a crowd, the way the crowd is going towards buying only, say, Sony TVs. Then we will also want a Sony Plasma big TV like theirs in our home. So why are we doing that? Do we really need that? Do we can we afford that? Can we really enjoy that? Is certain questions we have to ask before we actually go into following the crowd. Now, the bubble that was mentioned in the book is basically, if anything, certain set of investors, they foresee that there will be a greater potential. They start investing and, the prices will go, push up the prices for a shorter period. Seeing that, many other people follow and gradually they also purchase. But the performance of the stock or the overall company might not be stable. So eventually at a point of time, the bubble bursts and we understand that the company's potential is not so. And in that course, we will lose up money if we don't have that understanding and that dynamism of the company's changing trajectory of the growth. And that's why the bubble bursts for us, because we go on the assumption that so and so person knows the market better. He knows something different. So I can safely follow him and achieve success. But he might quit at the right moment and we will continue because we would have not closely looked into things. And he will still gain and we might not gain. So bursting of the bubble comes because in the stock market, for a shorter duration, there creates a demand. Eventually the company cannot stay up, so the demand, the stock prices fall and we end up having a loss. So that is the bubble burst concept, which is mostly pursued on a short-term perspective. Those investors have a short-term target, while our target might be quite long-term. We want to invest money for say 5 to 10 years. So those are the different parameters or the different assumptions, the different requirements that two investors can have. So that is what I think this chapter tells us, that copying each other might be misleading at times. It is okay to buy a car maybe together because you might be using it and having it. But if it is a much more major investments, we'll have to be careful. So this is what it is. So it was a good reading today. So thank you for your patience and kind attention. Anyone else wants to add anything here? Okay. So thanks everyone. Yeah, Manishi. Anything?
Yeah, I just want to add one thing that, whether it is investing money, psychology, or about investment in life also, we need to set the rules of the game basically, because sometimes, due to watching TV, watching newspaper or listening to others, and sometimes we get away with emotions, this is good or this is bad. But when we do our own research and set our rules of the game, we are not affected by this volatility and other news or any other thing in the investing or whatever it is. So just setting your rules and just follow your rules and keep noting your mistakes so that you don't repeat the mistakes, because mistakes are bound to happen, because there is no easy money, right? So you need to put investments, so you have to take the losses also sometimes, but everything should be in control. So it's all about, failing to plan is planning to fail. So we need to the rules of the else, and just just to follow your real rules on a regular basis, so that if you make some mistakes also, you can fix them, right? So it's just about setting the rules and doing journaling, reviewing them regularly, and if you need any help, talking to the experts, like what experts do and things like that. So just be keeping ourselves fully aware and just follow the rules of the game. I think that will make a lot of sense to me. Yeah, thank you.
Right. Thanks, Manishi, to end it in a way that regret is not a useful emotion or a feeling, I guess, because eventually things will not turn out always good and well. So we'll have to bounce off much faster and accept it as a lesson. Yeah. So with that, I think we can close for the day. Thanks, everyone. See you tomorrow. Yeah. With the next chapter.
Thank you.
Thank you.
Thank you all.
Thank you.
Thank you so much.
Bye. Thank you.
I'm taking the summary.
Yeah, I have also posted in the group. Yeah. Thank
Okay.
you.
Okay. Thanks. Bye then. See you tomorrow.